Hi, I'm Mark Honeybone from Property Ventures, and welcome to our podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. To check us out, take a look at propertyventures.co.nz. We hope you enjoy today's podcast. So welcome to the show, Andrew.
Thanks for that, Mark.
Okay, so just so listeners know who we're talking to today, just tell us a bit about yourself and how it all began with investing for you.
Well, my name is Andrew Bruce. I'm originally from Christchurch, and when my background is I went through school and university down in Christchurch. I trained up as a valuer, and once I'd finished valuation down at Lincoln University, I ended up getting an offer to play and coach tennis over in Germany. So I spent a year and a half playing and coaching tennis, and basically sport's been a very big part of my life. So I went over there for a year and a half, and then decided I didn't want my degree to get too outdated, so I came back after that period of time and ended up couldn't find any work down in Christchurch at that stage, so moved up to Auckland and actually worked as a government valuer. It was called Valuation New Zealand back then. I think it's now been rebranded Valuation Quotable Values now. So I never actually went through and became a registered valuer, but I always felt it was a really good training ground in terms of just assessing values of properties. And certainly you learn a lot at university, but you definitely learn a lot more at the coalface when you're actually doing it. So always had an interest in property, but didn't really know how I was going to move it forward. And from Valuation New Zealand, I then moved and worked in the private sector for a while. And it got to the point that I thought, okay, I wanted to move into another role which the hours weren't quite as demanding, and so I ended up going into a project management role at Auckland City Council back then, and that a couple of reasons for that. One, I wanted to firstly understand how the processes of council worked, and secondly, it was a 40-hour-a-week job, so therefore, come 5 o'clock, I could then move off and do my own thing in a property sense. So I'd always had an interest in property, but I just didn't really know exactly how I was going to go about it.
Straight away, that's a pretty good background for starting in investing, being a valuer. Buying right, as you all know, is one of the main parts of property, and also inside of the council must have been a real benefit later on when you did start to buy properties.
Yeah, well, what I basically did is I was all fired up, wanted to get right into it, and then I went off and bought a property, our first investment property, and we bought it well, and we added value to it. We basically went through, spent all evenings painting it up and all weekends painting it up and doing all sorts of bits and pieces. And we got all fired up. We're going, yes, we're going to get right into this. But then things take over. Your 8-to-5 job takes over, and I basically, and the property worked quite well from the point of view. It was also positively cash flowed, and we created some instant equity in it. And I sort of lost focus a little bit. And before I knew it, an entire sort of property cycle had gone. And I was going, crikey, this isn't that great. I was planning on getting right into it in my 20s, and I bought one property. It worked well for us. But to me, it's, the knowledge and all that's great, but you really need the motivation, because everyone's time pressed in today's society. And it just comes down to where your priorities lie. So basically for me, at this stage, I was starting to get towards the end of my competitive tennis that I'd played for a very long time. Pretty much, as I said earlier, sport had been my life. And then I'd always had a bit of a goal to do the Ironman, which is a very, very long triathlon. It was down in Taupo. So that was been on my bucket list for a long time. So I went off and did that. And I can vividly remember, like the Ironman it's a 3.8k swim, it's a 180k bike, and then you finish it up with a marathon. So to take this sort of thing on, you actually have to do a lot of training. And it's quite a individual type sport. It's quite selfish, actually. And I can remember doing one of my long rides because I had no background in swimming or cycling or running, but I'd been a competitive tennis player, but I'm certainly not built to be a runner, cyclist or swimmer. So on one of my long rides, it was a 200 kilometre ride. I can remember taking the day off annual leave. I left before my partner, she went to work. And by the time she got back from work, I was still out there riding. And I can vividly remember on that ride and thinking, once I'd finished doing Ironman, I've got to get into this property thing. I've just got to. And I didn't know how I was going to do it at that stage, but I'd set myself a goal. So therefore, post Ironman, once I'd finished doing that event, I'd got something else to focus on. And at that stage, I can remember seeing a little article in the paper about this Property Investors Association up here in Auckland and how they were running events. I thought, wow, that looks really interesting. And I'm not the world's greatest networker, and I know a lot of people really struggle with networking. I thought, oh, do I want to go there and all this sort of stuff? And then I basically forced myself to go along. And what I found, it was like I put this diary note in. It was in my diary, an appointment in my diary, the second Tuesday of every month. So I forced myself to go along to these meetings, and the first few were quite hard because you don't really know that many people. But then they had smaller meetings as well where it was easier to network. And you met some really, really interesting people. And you also heard some interesting speakers. But really, to me, the greatest benefit I've got out of it is the networking. And I can remember talking one day, and then someone said about this thing called recycling of equity. Now, I know probably a lot of you listening to this will go, oh, that's so basic. But to me, once that clicked, once the light bulb, the switch went on, it was like, wow, so you don't actually have to try and save your deposit while you're also still trying to pay off your own house. And because I was wondering how people actually did this. Because, not everyone's on massive salaries that they can just go off and pay off their mortgage, and then once they pay their mortgage, then start saving for an investment property.
Just to interrupt there, Andrew, for the newer listeners who are, newer investors who are listening and don't really understand recycling equity, just want to briefly tell us about what that is.
Yeah, no, sure. Recycling equity is you try and add value. Well, what I tried to do was add value to a property. So let's say, for argument's sake, you buy a property for $500,000, and you either buy it below market value, or you can add some value to it, and whether it be painting it or subdividing it or whatever, adding an extra bedroom. And then say in 2 or 3 months, you can get it revalued up from $500,000 to $600,000. So what you then do is you basically get the valuation at $600,000, and then you go back to your bank, and originally you would have borrowed 80%. So 80% on the $500,000 is a mortgage of $400,000. So therefore, once you've got this revalued up to $600,000, you once again go back to the bank and say, okay, Mr. or Mrs. Bank Manager, this property is now worth $600,000. I would like it to be valued up to take 80% of $600,000, being $480,000. So in the bank's eyes, you've actually created an ability to borrow an extra $80,000, the difference between the $400 and the $480. Hopefully that's clear to people.
Yep, that's right. So then you've basically got your money back, your first $100,000 you put into it, and then the recycling mean you just carry on, and you can then look at buying, once you've got that 20% back, buying that next property.
Yeah, that's exactly right. So then I actually started to understand you can actually create this value, what I called sort of sweat equity. So whether that be meaning you're painting the place up, doing it up, or whether that means you're finding the good deals. And let's face it, at different times of the market, it's easier to find good deals as opposed to other times of the market. That comes through markets in different market cycles. So yeah, once I actually started to understand about this, how the leverage worked and how you actually utilize the recycling of equity, it started to dawn on me. I thought, wow, I can actually buy. I don't just have to try and buy one property. If I can buy my first property well, I can utilize that to then try and get into my second property. Now, there's always two components to borrowing. There's the equity, and when you're first starting out, equity is always very difficult because you don't have a lot of equity. You probably haven't been through a property cycle, so you may not have had a lot of capital gain in your in whatever assets you've got, if you have any assets. So there's the equity side of it, but then there's the serviceability. And for investors that have been around a long time, generally it's the serviceability. And when I say serviceability, that is your ability to be able to pay your mortgage. Now, we look at it from the point of view, okay, what is our rent, and then what the interest costs are, and there are other costs over and above that, like your rates and your insurance and your vacancy and your repairs and maintenance. So it's very, very, to me, it's very, very important to look at the cash flow of these properties. And then we talk about returns. Now, a lot of people just talk about what they might call a gross return. They basically just go through and times the rental by the amount of weeks in the year. So they get a maximum total rental that you can actually get for that year. And then they'll divide that figure into the purchase price of the property. And that will give them a percentage return. Now, to me, I feel that's a little bit misleading because I always like taking out the costs, because you know there are some costs that you're just not going to get, you can't avoid. So whether it's a freestanding house, it'll be rates, insurance, repairs and maintenance, property management fees, and there, you should make an allowance for vacancy as well. And whether it's an apartment, there'll be those costs along with body corporate. You will find that the insurance is actually incorporated into the body corporate costs. But to me, it's really important that you work it out on a net return basis. So you take all these costs, deduct it off what your maximum total rental is, and then divide it into your purchase price.
That's when you get your true figure, what you're really earning from the property.
That's exactly right. And then you can compare that and you go, well, look, that net return, that might be 4%, or that might be 6%, or whatever it is. And then you compare it as to what you have to pay on your mortgage. And then you can work out, is your property negatively geared, positively geared, or neutrally cash flowed? And certainly at different times, it's always difficult finding neutrally or positively cash flow properties. It is possible. In fact, I actually unfortunately just missed out on one this morning, which would have been positively cash flowed. But they are there, but it is very, very difficult to find them, particularly at different stages of the market like we're at the moment.
Yeah, and obviously Auckland's it is very hard to find that at the moment. It just was that an apartment in Auckland, or was that another sort of property that you were looking at today?
Yeah, no, it was an apartment, and apartments don't suit everyone because sometimes they do require a little bit more equity in terms of your loan to value ratios, because the banks, depending on the size of them and if there are any issues with the apartment, as to what the bank's criteria are, and sometimes they almost take an individual type criteria on different apartments in different sizes. So there's no sort of one size fits all there.
And just on that one, I think that the banks have different rules slightly from how big the place is, but generally it's about 40 square metres, I think it is, isn't it? When it's 50% lending only, they'll give. If it's less than that, and some I think go to 50 square metres.
That's
they
that's
get
exactly
50%
right.
lending.
Yeah, that's exactly right. So basically what we ended up doing is we started to understand how to go about this recycling of the equity. And then we go, well, we've got to find properties that are cash flow at least neutral, ideally positive. And then you start targeting certain areas. And like there are some areas that look really good on paper, but then you've also got to look, it's all very well for it to look good on paper, but you've got to ascertain what sort of tenants are you going to be dealing with, because realistically, they are your clients. So, are they able to pay the rent? Are you going to have various areas that are going to maybe be a little bit harder on repairs and maintenance? Different types of properties will have higher repairs and maintenance, higher vacancies. So as we've developed our portfolio, we've targeted slightly different areas as opposed to maybe when we first started out our portfolio and we had to look at what I would call the real investor areas, which are, like in Auckland, for argument's sake, South Auckland is an obvious example. And I'm not saying all areas in South Auckland are bad, not in the slightest, but certainly some areas in South Auckland, it can be quite high management, and that can wear you down after a while. Particularly if you're trying to manage it and working 8 to 5, it can become quite difficult. So we ended up looking at targeting some of the apartments, and you needed a little bit more equity with some of them because we were going for some of the small apartments where you needed to put 50% equity in. But what I quite liked with that is the person that you were dealing with was either an English language student, or it might be a young couple that are wanting some privacy and wanting to live by themselves. So generally, and I'm speaking very generally here, generally speaking, I certainly didn't have as many, say, vacancies or bad debts in those types of properties. But in saying that, we don't solely just focus on the apartments. We've looked at other areas as well. And one of the things I've actually quite liked doing over the years is following where public and major private infrastructure work has gone. And that sort of worked quite well for us. We've done that in Rotorua, where there was some significant road widening coming into Rotorua, and we looked at purchasing along those areas. In Hamilton, we've looked at purchasing in and around big bits of public and new private infrastructure, being the hospital down there. We purchased an old motel there with some vacant land so we could try and add some value to it. And up in Auckland, once again, the rationale that I've been used up here is we looked at purchasing some stuff out in Flatbush in about 2010, I think it was. And that was once again a huge amount of public infrastructure money was going into Flatbush, so you knew people would be coming there. And the other strategy I've liked is we know that Auckland is just getting busier and busier and busier. It's harder and harder and harder to get into the city. So I've tried to target having properties in and around the central area, because to me, they are always going to hold their value.
Yeah, it's just so important. There's so many factors you're trying to get to do that recycled equity you talked about early on, and any advantage that you can do along the way, and that's whether you've added value or not, or even as small a point as being, as I said, near new infrastructure or whatever it might be. If you're always thinking ahead, why is it going to add value or gain more equity, and then if that's just near any new infrastructure coming up is great, especially if you know something that's coming up a year ahead or 2 years ahead. That can obviously accelerate your growth straight away as well.
Well, this information is publicly available information. It's at councils. There's no hiding it. And the one thing that we tend to be very much in the investor category. My personality type is more an investor type of person as opposed to someone who's wanting to trade and buy and sell. And we've done the odd development. In fact, we're doing a development at the moment, and that was actually more by default than anything else. We originally purchased the land with a view to building 3 houses on it, but we bought it at a very, very good price, and to get it at that price, I basically had to go cash unconditional. So I didn't do a huge amount of due diligence on it, but we got it at a price that I knew was going to work, and I'd just make something work later. And as it's turned out, my original plan of building 3 houses from a cash flow, from a capital gain point of view, would have worked very well. But from a cash flow point of view, it really wouldn't have worked that well, particularly with the costs associated with building. And so I've decided to basically just develop the land, accept it's a development, obviously pay the tax on the way through, because the costs associated, or the profits we will get associated with just doing the subdivision, will be about the same as if we built the 3 houses as well. And if we had to build the 3 houses, we would have taken a significant amount of more risk through having to borrow a lot more. So from our point of view, we just decided that wasn't really worth it. So while the original intention was to hold, we will now be basically buying and developing and selling that. But that certainly isn't a major strategy of ours. Our strategy is very much looking at the time in the game. Now, if you can time your cycles right, that's brilliant. But to me, if you've got a long-term horizon, that is incredibly valuable in property, because once you actually see how the compounding growth can work, because what have they said? Compounding is the 8th wonder of the world, I think I heard. Once you see how that can actually work for you, and particularly one of the benefits I see of property, other than the fact that I like to be a bit of a control freak, so I like to do things myself and educate myself and have control over my investments. But one of the things that differentiates property, say, from shares or bonds or whatever, is you have the leverage of property. Now, leverage can be a double-edged sword. Like through 2009, 2010, like if you were going backwards, leverage is definitely a double-edged sword, and that's why I'd come back to cash flow being incredibly important. If your cash flow is cash flow neutral or ideally cash flow positive, you can ride out those cycles, and therefore you can have your time in the game. Like you can have your longer term horizons. And to me, that's an incredibly powerful thing with property.
And I've said that a few times in the other podcasts in 2008 to sort of 10 or 11, when people unfortunately fell over and when bankruptcy and mortgagee sales, a lot of those people, they just didn't have that cash flow, and they couldn't ride through those bad times. And when that happens, they have to go back to the bank, and or the bank come and see them because they haven't got enough. And then when the prices of property have dropped, and then the bank find out, one, they haven't got the cash flow to pay for it, and secondly, the equity's now dropped considerably and will be under 80% of which they would like to have. That's when people run into problems.
So what we basically did in terms of this compounding and how it's worked for us, like if someone said to me maybe back in 2005, oh, you'd have the portfolio we have now, and we've got a couple of motels in that portfolio, I would say they'd be absolutely crazy. But through the ability for us to be able to add value through the sweat equity, and then going through the property cycle and actually utilising that equity, it's given us the ability to actually buy an old motel, which is now rented out as low-cost residential accommodation, and with that motel, it had some vacant land with it. Now, when we bought it at the time, I would consider that we got a fair deal. I wouldn't say we got this deal of the century, but I'd say we got a fair deal. It was reasonable, but the kicker for us is that it had some vacant land. It had 1,349 square metres of vacant land with it, and that was fronting on to Kahikatea Drive, which is State Highway 1 down in Hamilton. And it was only about 200 or 300 metres away from a brand new private hospital that was being built. They were building a $30 million Braemar private hospital, and that's now expanded again to another $12 million expansion recently. And then just just beside that, there is the big public hospital, which covers a massive area within the North Island. So basically, what we've been able to utilise is we subdivided that land and created some extra value with that land. Then we looked at all sorts of different options. We went from options of looking at putting a 10-unit apartment complex in there, a 12-unit apartment complex, a childcare facility, and we actually got a consent for a 12-unit complex there, but for various reasons we weren't able to move ahead with that due to particularly some conditions of consent that were rather onerous. And so we ended up sitting back and reevaluating, and then we ended up getting a consent for a second motel. And we certainly, if I was just working in my day job, I would have never been able to save up the equity to actually be able to build this motel. It was through the equity that we were able to generate through the compounding growth from our portfolio. So we utilised that equity to build this motel. We then sold the business in the motel. So this was our first venture into commercial. Sold the business in the motel and then held the underlying land in the buildings for a long-term lease. So, and that's worked out well for both parties. The people that now run the business run it very successfully. In fact, they're the number one on TripAdvisor within Hamilton, which is great, because if they're successful, they pay our rent, and so they're happy, we're happy. It's a win-win for everyone.
So just for you now, so that's a total hands-off investment at the moment, while they've got that lease there, and they're increasing your equity pretty well.
Yeah, I see it as a little bit more of maybe a defensive play as opposed to, because maybe the capital gain won't be quite as good as possibly, say, residential, but certainly the return, the cash flow return is better, and it's a net return. So they pay the insurance, the rates, all the costs. So the money we get in each month for rent is the money that we can pay off our mortgage, as opposed to obviously a situation in residential. So look, there's pros and cons in both areas, but the thing we like about it is exactly as you said, Mark. It's pretty much a hands-off. It's a hands-off management now, but there was a lot of work to get it to that point. And yeah, as I said, I probably don't see it being quite as much capital gain as maybe if we invested that money in, say, the Auckland residential market, but the cash flow side of it was key for us. And that's generally what I've tended to very much focus on, is the cash flow component of our portfolio. Like, I'm in my mid-40s, so I've still got some capital gain assets, but the bulk of our portfolio is cash flow. When I'm starting to get closer to retirement, basically as I envisage it at this stage, and let's face it, we learn all the time and things change.
Absolutely.
The closer I get to retirement, I would see the more I would very, very much be focusing on the cash flow component. I think that's one of the key things that I see a lot of investors coming in, and they go, oh, I'm going to buy this house, and it's going to be a 3-bedroom house, and it's very similar to the one I live in, and this and that, but they never actually do the calculation, the very basic calculation of working back to see what the cash flow is, the net cash flow, and compare that against what you're going to be paying in terms of your interest rates.
Yeah, so Andrew, so cash flow has obviously been an important part from what you've done all the way through with your investing. And that's important for you to, as I said, for when you're retirement age and what have you. So it's all very nice, and people have all the theory, and they read books, and they go to different meetings and what have you. And I suppose the hardest thing is actually how you find those properties. And I guess coming to a good property finder would be good. But also, actually, you just have to make that step sometimes to get across the line to actually do it, to actually make a decision to do it, but you still have to actually, get that right. And part of that also is setting up the right team of professionals around you. So you, like you said before, you brought a place you hadn't done that much due diligence on, but you went unconditional pretty well straight away because you knew it was going to be a good deal, no matter So I think that's a part of the whole process of actually setting up, getting the finance, having a solicitor or whoever it might be to get going.
Yeah, look, I would totally agree. I think education is incredibly important. Like, let's face it, education is the best return around. We can talk 6 or 7 or 8% returns for property or whatever you get in bonds or whatever you get in the bank. But for every dollar you spend on education, you would at least like to think you're at least going to get $1 back in value. So education is incredibly important. But
just on that there, well, your background, you're obviously a pretty self-motivated person, and with your sports you've done, they're I suppose, a lonely sort of sport. When you're running and sitting on a bike, you can't talk to too many people, and you said you by nature you're not a great networker. You sort of said. So I suppose that's the difference between property. Property can be very, very lonely. I was at a conference the other day with a few people. In fact, you're on the same conference, and we spoke about it was a whole lot of traders getting together. And that was important because it can be a lonely game or sport or industry. So getting into groups like networking helps you actually making that decision, and you're around like-minded people. And as I said, education is massive because you need, not only is education, you're with like-minded people, you learn from other people, you get inspired by other people.
I hate to say, but we're going to stop it right there for this week.
Absolutely. It keeps you motivated. Like I was saying earlier, we bought this really good property very early on in our career, investing career, and then we did nothing for 4 or 5 or 6 years, whatever the time frame was. And it was purely, we just sort of lost focus. And that's why I joined APIA. And, other people do the property mentoring, or there are various mentors out there and all sorts of things. But so education is incredibly important, but in the end, you still have to pull the trigger. You've still got to do something. You've still got to be able to take action. And it's scary. Like the very first property we bought, it was scary. The very first time we did our bigger deals in terms of buying the motel, we were scared. But the more you do these things, the more you understand it, the more you start knowing people in that industry, you get better teams around you, and you can bounce ideas off people, and you get more and more confident. You never want to get overconfident, because this is a game that can bite back. It definitely can bite back. But you do have to take action, get motivated, and that's what I like so much about APIA. You're always learning stuff, or the conference we went to a couple of days ago. You're learning from what other people are doing. You're just hearing their stories. Because if you think you've got a specific issue that you're dealing with, you're almost guaranteed other investors have had the same issues, whether it be struggling to try and get their serviceability or in finance, or how in the world do you get your equity for your first property. A lot of people have had exactly those issues. So it's good to be in a network of people and just bounce those ideas off, and just one way or another, you find a solution, because we've got guys in their 20s up here in Auckland that are doing phenomenally well, but they're incredibly motivated, and they aren't on massive salary jobs, but they're incredibly motivated, and they just pick up a lot of information and take action.
And what I like about the different investor groups and the PIAs or what have you is education by reading books is fantastic, and a lot of people, that's where they start. They start their education by reading a book, and as I said, they're a very valuable tool. Also, the great thing about the PIA and other, such networking groups, you get current, up to date every week, every day, every month, whatever it might be, and it's not all stuff 6 months ago or 2 years ago or the last cycle. It's what's going on in the property world right now today, and you can't beat that when you're sitting at home by yourself reading the newspaper that talks about figures of 6 months ago, which general Joe public do.
Yeah, no, that's totally the case. That is, and it is so amazing. There are so many unassuming people at these meetings. Like, we run 100 meetings a year, and we have anywhere from 10 people to them to 300, depending on the meeting and the speakers and all sorts of things. So there's so many different meetings out there. There's so much information, and so many people just want to help and knowledge share. It's just absolutely invaluable. So it really comes down to just how motivated you are to get out there and do it. And, there's always going to be hurdles in the way. but it's a matter of, how do we overcome those hurdles? And yeah, like to me, what I do is it's a voluntary role. It's a non-profit organisation. We've got no axes to grind. All we're really there to do is provide education and networking opportunities for investors.
You've obviously enjoyed it. You've started off going there to get confidence to get buying your first properties, and you reckon you're not such a good networker. You've obviously done okay in there, and as we said in the introduction, Andrew's now the president of the APIA, the Auckland Property Investor Association. So that must be a great role to be a part of, and I suppose as part of that, and along with all the inspiring other people and listening to all the guest speakers and networking, I suppose you've actually got in your role, you can actually fight for the other investors too, which must be quite a nice feeling.
Oh, absolutely. We're affiliated to the New Zealand Property Investors Association, and they do a lot of lobbying. We also get to find out some bits and pieces of information as to what's happening out there. And once again, it's what I do is voluntary, but I get a lot of enjoyment out of it. But you meet a lot of very interesting people. As Mark was saying before, you're wanting to get a good team around you. You're always meeting different people, interesting people, and these people have got a lot to add. And let's face it, you never stop learning. You never know it all. And to me, that's the key thing.
Absolutely. So just so we I think how do we plug? But so if someone does want to join the APIA group, where do they go and what do they do?
Well, we'd love you to come along and join. We've got a website at www.apia.org.nz, or just ring Serena, the general manager, on the phone at 360-2376, and she'd love to have a chat to you, and we'd love to see you.
Yeah, we'll put a wee note on the website when you've sort of come in here, so you'll be those details there again for any listeners that want to. So just sort of closing, any other comments or any hints for the newer investor? I always like asking my guests that and see what they say. Yeah, there you go, Andrew. What do you reckon?
That's putting me on the spot a bit.
That was you a couple of years ago.
Yeah, look, to me, I think the key thing is you've got to look at where your strengths lie and figure out, where your cash flow position is, where your equity position is, and also are you going in with a partner, what their risk tolerance is, because it's all very well you going in and buying some properties and then your partner not being very happy with it at all. That doesn't necessarily always end well. So just being really upfront as to getting your basic structures in place correctly, get some education, and then look, ideally, from my point of view, I like looking at a long term with cash flow. So target your areas. Don't do the scattergun approach that going all over the place. Target your areas, and there are also people that can help you with that, like with Mark with his property ventures and property finding. So it really just depends on where you're at and how much time you've got. But yeah, just if you can get motivated and take action.
Yeah, that is great. And one of the things that you've said, which obviously you're very good at, is you not only buy well at the start, which is important, but you go into each deal with other options. And if that's something people get out of today, as you said, if there's always more than one option to have when you buy a property, we say what can go wrong, or things can go wrong, but if it's not just a one only strategy, that's really important.
Absolutely, and actually the one thing I haven't touched on a lot here is once you've bought the property, because the hardest work is actually finding that damn deal. It is so hard, and people get sick of it and they get bored and frustrated, and it's really tough. But once you've found that deal, there's a real sense of satisfaction of being able to draw your equity out, recycle your equity, and then move on to the next one. But once you've moved on to the next one, you've got to make sure you manage them properly. And if you don't manage them, get someone else who does manage it properly. Because property is not a set and forget game. You've got to manage the properties well, whether that be you or whether that be someone else.
Definitely, that's a great point to finish on there. So, Andrew, hey, thanks very much for your time today. It's been a great wee chat there, and I'm sure particularly newer investors will get a lot of benefits out of today. So yeah, thanks for your time, and who knows, we might get you back on again sometime later next year. Who knows?
Oh, thanks a lot for Mark. It was really enjoyable.
Great stuff. Thanks. We'd like to thank Andrew for his time today with us. If you have any questions about anything Andrew said or anyone you'd like to hear next year in our podcast series, flick us an email at info@propertyventures.co.nz.